Wanted to take a look at SPX today. We have economic data on Wednesday. The CPI report's going to come out, and I've got a chart on the month over month gains that we've been seeing over the past 3 months for inflation. They are quite elevated. We've seen some big spikes, and this will really drive SPX as it will drive Treasury yields. If the number comes in a little hotter than expected, Treasury yields will pop up, SPX will sell off. Fair enough. Ultimately, however, my take is that interest rates are about where they're going to be and stay there for some time, but the Federal Reserve doesn't have a whole lot of room to be moving interest rates right now, despite what we might be getting on Wednesday. The presidential election's coming up. It's only, 5 months away? November 5th, Tuesday. They have a meeting on the 6th and 7th. The Federal Reserve is very likely to leave interest rates where they are. So should we see a spike higher in bond yields, SPX, of course, will sell off, but then probably shrug it off and move back upward like it's been doing. However, eventually we'll see movement in employment numbers. Then SPX may sit there and say, listen, wait a minute. Despite the fact that the Federal Reserve will be lowering interest rates, they're going to have to do so rapidly because the economy is shrinking. Let's jump in and I'll show you some charts that I'm paying attention to that could drive SPX and what might happen over the course of the next couple of months. Let's jump into the computer. Here's a chart on SPX. This is actually the 4-hour bar chart for SPX. The selling we've just seen all through April, SPX, of course, had peaked out, sold off. And it was because of inflation concerns. We were getting the Federal Reserve chiming in. We were getting inflation data coming in month after month over the past 3 months, really elevated. And I've got those charts. I want to show you those. But since then, the market's pretty much shrugged it off. The U.S. 10-year Treasury has kind of moved lower on yields. It was pushing about 4.8. It's now down to about 4.475, somewhere in that range. But I also wanted to show you, this is since the kerplunk in March 2020 when the world shut down. These are all 11 components of SPY stock. And what I did, I wanted to take a look at this because I'm breaking down each of the ETFs. SPY stock, of course, is an ETF based on SPX, and it's an excellent way to trade SPX. But the 11 components, what you can see when you break this down, you can see which ones have underperformed or overperformed SPX, broadly speaking, or SPY stock in this case. The purple one, believe it or not, that is energy. Energy companies have been basically raking in. The one underneath it, the light blue, that's XLK stock, which of course is technology sector, Apple, Google, and companies like that. But when you see this, it really is eye-popping how much energy of all things has popped up. Now, I just did a video on XLE stock, how I plan on selling it. I have started taking positions. I'm also taking positions, a short position on USO stock, because I believe that because interest rates are starting to trend a little bit higher, they're going to remain there. We'll see supply levels increase on oil and price will come down, and these energy stocks are probably going to take it. So here's core CPI inflation month over month. And the important thing here is that it is core. And as you can see, the past 3 months, we've had some elevated numbers. Now, I went and I took a look at what's the median, the average, going all the way back to 1990, might have even been before that, but a very large sample size of the core rate month over month. What is normal? About 0.23% increase month over month. Now, the previous 6 months, 7 months, just before these three pops higher, was well below the 0.23 median level that we saw before. Now, the big drop we saw back in March 2020, you can see that there. All right, what are we going to get this month with CPI on Wednesday? That should be interesting. There's really no catalyst that would push it higher or lower. Employment numbers came in on Thursday last week. We saw a small spike higher in initial claims, but continuing claims are really kind of trending downward still. So the employment situation has not shifted much, but we're also not seeing much in the way of growth with regard to overall economic expansion from incomes and expenditures. Expenditures are now at this point sort of leveling off, and this really drives things. But at the same time, there's a big asterisk there because the Federal Reserve had interest rates for so low, we had a housing bubble, and now housing supply is heavily skewed. So I don't believe that, despite the fact that we're sitting at 3.8, it's about 3.86% unemployment rate, that the high level of interest rates is really going to drive unemployment higher. Again, we saw a small pop higher in initial claims, but this is far from a fix. Wanted to take another look at the S&P 500. Here's the U.S. government Treasury bond from this angle. Now, like I said, we were sitting at about 4.7 last week, and throughout the previous 2 weeks, we've come back down to about 4.5. I think it settled about 4.47 for today. What will happen with inflation numbers on Wednesday? We're going to find out. I believe that regardless of the number, interest rates are going to remain pretty much where they are. And I'm getting ready for Treasury yields to eventually move lower. I have been buying in TLT stock heavily. Here's a good look at the daily chart on SPX. I kind of have a feeling we've peaked out a little bit here. My thinking for Wednesday is that the number is still elevated, and that from there we're going to see SPX moving lower on interest rate yields moving back upward. My thesis remains the same, that the Federal Reserve is going to have to restrict economic activity. We're already seeing a flat line in income growth and expenditures. There's really no one new to put onto the payrolls, and because of that, there's really no growth spurt that's going to move forward. Now, I'm not necessarily saying there's going to be a recession or anything like that, as much as I'm saying that the growth rate will decline. We will see some unemployment. This could be a soft landing. The Fed might look like a genius. I'm doubtful. They usually mess it up. That's my take with the Federal Reserve, and it always will be my take with the Federal Reserve, that they move in extremes that mess up the economy, just like they just did with keeping more interest rates so low that mortgage rates were trading at about 3.25, 3.5, 3.75, and that caused a housing bubble, and then it caused price spikes of up to 70% in inflation. And they sat there and like, oh, it's transitory. This inflation isn't going anywhere, so we're not too concerned. And then they were in a sprint to contain it. They'll mess it up again. In the meantime, Wednesday's number, looking for a pretty decent month-over-month increase. I see nothing that would necessarily make it go higher or lower at this point. That will probably trend slightly lower than what we saw last month. Bond yields, Treasury yields will pop higher. SPX stock, or SPX, the index, will sell off. SPY stock will move lower. So whether you're trading SPY stock or bonds, that's where I'm kind of moving. I've been buying TLT stock. I'll put an end card at the end of this. My take is that the Federal Reserve for interest rates will remain where they are, but that eventually they have to lower rates at a pretty decent little clip to spur normal growth back up. Because of that, TLT stock moves higher. In the meantime, SPX might have peaked out here. The growth rate, because it declines, means stocks need to be revalued with their rate differentials. Make sure to hit the like and follow button if you're just finding this channel for the first time. Also, if you're looking for written content on this, I've got my link for my Substack down below. We'll see you in the next video.